Hello everyone and welcome to this recording. In this chapter we would be discussing about life, health and disability insurance. What is life insurance? Life insurance is obtained by purchasing a policy with the insurance company promising to pay a lump sum to the person specified as beneficiary at the time of insurer's death or sometimes while they are alive. In some policy, money is paid to the policyholder if he or she is still alive at a future date. Company makes promise to pay in exchange for payment of premium. So key terms in life insurance. There is an insured person. So let's say I'm the insured person and there is an insurance company. So let's say Sun Life is an insurance company. So what do? I pay regular premiums to Sun Life. Okay, and I can have two policies. One policy pays only when in the event of my death to my beneficiaries, so I pay premium, and the insurance company Sun Life takes on an obligation to pay my beneficiaries in the event of my death. This is first case. Second case can be I pay premiums and I buy a policy which pays either in the event of my death to the beneficiaries or to me at a future date. So it's like a savings plan. I keep on giving premiums and at a future date I get them back. So the purpose of life insurance is to protect someone who depends on you from financial loss related to your death. So proceeds may be used to pay off your home mortgage and other debts at the time of your death, provide a lump sum payment through an endowment to children when they reach a specific age, provide an education on income to for your children, make a charitable donation on your death, or provide for a retirement income. So if you ask me what is the purpose of life insurance policy, it is to support your beneficiaries. So pay off the immediate expense that results as because of death. So immediate expense can be the service charges, the funeral charges and whatnot. Then pay off all your debt, so credit card debt, mortgages, etc., and to provide a supporting income to your beneficiaries until they stand on their own feet. Okay, the proceeds may be used to pay off estate debt at the time of death, provide education for and income for survivors, make charitable donations, or accumulate savings. Life insurance is one of the few ways to provide liquidity at the time of death. Principles of life insurance. So life insurance is based on the mortality rate. Mortality rate means the probability of a person dying. So what mortality rate is defined according to age. So probability of a person dying at the age of 30 is less than the probability of a person dying at the age of 60. So mortality rate will be less at the age of 30 vis-a-vis at the age of 60, and insurance is based on mortality rate. So mortality table provides odds of you dying based on your age and sex. Your premium is based on your life expectancy and projections for payout for a person who dies, adjusted for factors that increase or decrease an individual risk and various administrative fees for the companies. So first thing, between genders, life insurance is generally less costly for females and it is more costly for males because probability of males dying is higher than females dying. Second, it also depends on your lifestyle. So if you're a smoker, the life insurance premium will be high. If you are into a profession that is more risky or more challenging, like if you're a stunt bite worker in Hollywood, then your insurance premiums would be high. And it differs from company to company because some companies have more administrative charges, so their premiums are higher, while some companies have lesser administrative charges, so their premiums may be lower. Now, the big question is, do you need life insurance? So, do you have people? So, you need to answer basically two questions. Do you have people you need to protect financially? And do you have a partner who works? So, if there are no dependents on you, there is no one who is financially dependent on you, then you may not need life insurance, because effectively there is no financial loss caused by the event of your death, because there is no person who is dependent on you. So you may opt out of insurance. But if someone is financially dependent on you, your kids, your spouse, your parents, etc., then you may need to look into life insurance. What are the objectives of life insurance? How much money do you want to leave to your dependents should you die today? And when you retire, what income do you need? How much will you be able to pay for your insurance program? So three things. Basically, how much do you want to give back? So in the event of death, so do you want to take care of your dependents for their entire life, or do you want to take care for few years until they cope up with the event of your death and the life goes on for them? Also, do you want your are you saving in a plan that pays you in future? So are you looking for using your insurance plans for your retirement? And how much premium can you afford? So based on your budget, I may need life insurance policy of 5 million, but I'm not able to afford it based on my budget. So my budget entails that I can only afford a policy of 1 million. So based on your budget also, your policy depends. Next is the income replacement method. Typically, you will need, how much insurance does a person typically need? So one way to look at it is 70% of your salary for 7 years when the family adjusts. So current gross income, not the net income, the gross income before taxes, multiplied by 7 and multiplied by 0.7. So 7 years is generally a decent time, means that is given to a family to adjust. Next, why do we take 0.7? Because some part of your salary goes towards you, so your personal grooming, your income taxes, etc., etc. So if the person is not alive, those expenses are not incurred. So that's why we don't take entire 100%, we just take 0.7. So this typically assumes a typical family with no liquid assets available that would otherwise reduce your life insurance needs. Next is this was the income replacement method. So take your gross salary, multiply it by 7 and multiply that thing by 0.7. That is the answer by income replacement. The second way to go about it is the family need method. It is more thorough than the first method, because it also considers employer provided insurance, social benefits, income and asset. So this is family need method. So what do? First you calculate whatever you have. Okay, so whatever you have in your bank account, in form of investments, in form of support from your employer, the employer provided life insurance, etc., etc. Then you calculate what your dependents need. So you need to cover your burial expenses right away. You need to pay final income tax. The final income tax is terminal income tax, that is paid if a person dies, so you need to have provisions for that. Estate probate and fees, mortgages, credit card debt, you have to cover all of that. Then you have to cover living expenses for your family for the number of years you wish. Then you need to have emergency fund for your family. You need to cover, maybe you need to cover children's education, etc., etc. So add all of that, that gives you amount you need. So first calculate amount you have, that is assets you have, insurance you have. Then calculate amount you need, subtraction of that is the additional insurance you need to buy. So just pause this side and go through it. It is self-explanatory. assets that you have, life insurance that you have. Part A, whatever you need. Part B, whatever you need covers your immediate expenses on in the event of death, then support to your family members to cover their education, etc., etc. And subtraction of the both is the amount of insurance you need to purchase. Next is type of life insurance policies. So the basic type is term life insurance. This is also called as pure life insurance because you pay premiums and you get covered. And this insurance covers you only in the event of death. It doesn't pay you if you stay alive. So protection, what is term insurance? Term insurance means protection for a specified period of time, 5 years, 10 years, 15 years, etc. If you don't pay premium, coverage stop. Generally, there is a grace period of 30 days until the policy. Generally, the insurance company gives you a grace period of 30 days. But if you don't pay within that period, also the policy lapses. There are certain options that are there in term insurance policies. A renewability option means that at the end of the term, you can renew the policy without having to give a physical test. Conversion option allows you to change your policy from term to whole life without a physical test. We'll discuss what is whole life in the future slides. Term 200. So this is a term policy that remains in effect until the age of 100. So generally term policy is for a specific period, 5 years, 10 years, 15 years, but this policy stays on till 100 years. So level premiums cost significantly less than permanent insurance. So policies that are means up to 100, overall the premium cost is quite lower than the equivalent of getting couple of term insurances till the age of 100. But there is a decreasing term insurance in which your premium stays the same but the amount of coverage decreases as your age increases. Permanent life insurance purchased to cover lifelong needs. So financial expenses, supplementing a survivor's income, capital gains, or providing for a dependent children, have level premiums which remain the same over lifetime of a policy. So the premiums of permanent life insurance are generally higher because higher premiums paid in the earlier years are held as reserves to offset the increased cost in later years. So permanent life insurance means you are covered throughout your life, and once you die, that proceeds are paid to your dependents. So the premiums are quite high in the initial years because these premiums take care of the higher insurance cost in the later years. And whatever you pay extra, that are considered as reserves. So reserves are also referred to as cash value, the amount received after giving up. So if you give up your life insurance policy, you generally receive cash value. It is used if you are unable to pay premiums and can be borrowed as loan. Upon death, face value of a policy is paid out to a named beneficiary. Permanent life insurance has following types: whole life, pay specified premium as long as you are alive, pay stipulated sum to beneficiary upon death, and has a cash value that is paid out if policy is given out. So you subscribe to a whole life policy. Whole life means you pay premiums throughout your life. Once you die, in the event of death, the policy pays to your beneficiaries, right? It also has a cash value because you're paying significantly higher than the cost of insurance. So the higher amount that you pay is taken as reserves. Now you can borrow against this reserves or you can withdraw a part of this reserve. Second, if you're unable to meet your premiums, those premiums can be paid from the reserves. Second type of permanent life insurance is universal life policy. Combines term insurance and investment elements, can pay variable premium amounts. Increased cash value reflects interest earned, guaranteed not to be less than a specific amount, uses current interest rates and can be changed to reflect prevailing rates that are there. Death benefits are flexible and can change premium without changing coverage. So universal life policy means you pay premium, some part of it goes towards insurance, the other part of it is invested. Now the returns that you get from this policy are, there is a basic minimum that is provided to you, a guaranteed amount, plus you also get whatever interest is generated from the policy, from the amount that you have invested. Then there is variable life policy. So third type, so premiums are guaranteed. So cash value equals performance of investment funds or other index. Minimum death benefit guaranteed but can increase. Risk of poor investment is something that you bear. So in variable life policy, instead of making guaranteed investments like the previous one, so this policy makes a guaranteed investment. So it invests into interest generating assets. So variable life policy invests in, let's say, stock markets or stock indexes. So your returns are based on a particular index. So if the index goes up, your returns, your policy value goes up. If the index goes down, your policy value goes down. So the returns are quite variable. Endowment life insurance coverage begins from beginning of the contract to maturity, guarantees payment of a specified term if you are still alive. So it is similar to universal life policy. So you keep on paying premium, some part of the premium goes towards pure insurance, some part of the premium is invested. So upon the maturity date of the policy, you are paid the cash value of the policy that in turn depends on the investments you have made. And in the event of death, you get the death benefits. Now premium that you pay depends on a lot of factors. So it depends on amount of insurance. So if you take higher amount of insurance, the premium is high. If you take low amount of insurance, the premium is low. Your health class, so what kind of health you have. So if your health is good and you're quite fit, the insurance premiums are low. But if you have some diseases, then the insurance premiums are higher. It depends on your age. So higher the age, more is the premium. Gender, it depends on whether you're a female, male, or the gender X. It depends on your marital status. It depends on your occupation. So what kind of occupation you are into. So maybe you're a stunt bike driver for Hollywood, then the insurance premiums are high. It depends on the lifestyle you live, that is the recreational activities you take part in. For example, if you are a skydiver, means if you skydive for your hobbies, then the insurance premium can be quite high. Types of insurance, the most common type is group life insurance. It is the term insurance that is provided mostly by your employers. So they make a group and they negotiate with the insurance company based on that group. So generally no physical is required, only proof of employment. So you need to work with that employer to get insured. The insurance stops the moment you stop working. Credit life insurance, so it is taken by the debt company. So generally debt is paid off if you die, and it protects not you but the lender, the bank. So this is something that you can just have a read. So it tries to summarize everything. So policy type, whole life, universal, term 200, and term. So period of coverage for a whole life is entire life, for a universal life is entire life. It is up to the age of 100, and it depends on the term. So it depends on the term of the contract, often renewable for additional terms, but usually not past age of 70 or 75. You cannot renew a term policy. Premiums are guaranteed, usually remains the same. Premiums are flexible, can be increased or decreased by policyholder within certain limits, because you make investments also. Term 200, again they are guaranteed, usually remains the same. guaranteed and remains the same for the term of the policy, but they increase with the new terms. Death benefits, guaranteed in the contract, remains level. Dividends may be used to enhance death benefits to the participating policy. So sometimes if the insurance company is profitable, they pay dividends to whole life policy holders. So that may increase the death benefits and the cash benefits. Death benefits are flexible, may increase or decrease according to fluctuations in cash value, may have multiple insureds on the plan. Term 200 guaranteed in the contract remains same, and term also it is guaranteed. Cash value, it is guaranteed in the contract. Cash value in universal life is flexible because it depends on the investments, may increase or decrease according to investment returns and level of policyholder deposits. Term 200 usually none, so there is no cash value in term 200 policies. Some policy have a small cash value, or others are there is no cash value. Usually there is none, no cash value even in term policy. Then dividends are payable for participating policies. So whole life policies generally get dividends, and other policies mostly are non-participating, so they don't get dividends. Advantages of these whole life and universal life: provides protection for your entire family if kept in force. Premiums cost usually stay level regardless of your age and health. Has cash value that can be borrowed or used up for protection if the premiums are missed, or withdrawals if the policy is no longer required. Other non forfeiture options allows the policy holders the possibility of continuing coverage if premiums are missed or discontinued, because it has cash reserves, right? So you can use your reserves to pay premiums. If the policy is participating, it receives dividends that can be taken in cash, left to accumulate at interest, or used to purchase additional insurance. Can be So main thing is whole life is a participating policy. So if the insurance company is performing well, it pays you some dividend. So you participate in the performance of insurance company. Can be an endowment plan which pays out benefit at a specific age. Term 200 provides protection up to the age of 100 if kept in force. Premiums cost usually stay level regardless of age or health problems. Premium cost is lower relative to traditional permanent policies. It is suitable for short-term insurance needs or specific liabilities such as mortgages. Provides more immediate protection because initially it is less expensive than permanent policy. So term policies are generally less expensive. Can be converted to permanent insurance without medical evidence if it has convertible options, often to the age of 65. Disadvantage: the initial cost may be too high for a sufficient amount of protection for your needs. So you need to take into account that because there is cash value, the costs are quite high. Maybe inefficient means of covering short-term needs. Cash values tends to be small in early years. You have to hold policies more than 10 years to make it justifiable. So if you're ever buying whole life or universal life policies or any kind of endowment, there is no point in giving up the policy before 10 years because then you lose money. Term 200 usually no cash values and no limited non-forfeiture values. So if term policies disadvantage: if renewed premiums increase with age and at some point higher premiums cost may make it difficult or impossible to continue coverage. Renewability: coverage will terminate at some point, commonly at the age of 65 to 75. A premium is not paid, the policy terminates after 30 days and may not be reinstated if health is poor. Usually no cash values and non-forfeiture options. So if you see, term policies significantly cost less when you're young. but as you age, the term policy cost more. Permanent life policy cost more when you are young, but as you age, the permanent life policies generally cost less. Now you have to take if you now you have to consider, means if you have to provide coverage for your dependents throughout their life. So if you have a disabled kid, then you need to cover his or her, means income throughout his life. So it is better to get a permanent life policy. But if you want to have coverage only for a specific period, so let's say when you are earning and you have a family who is dependent on you, your kids are still young and they're studying, and you want to only cover that part of the portion, it is better to get term insurance. Important provisions in a life insurance contract: naming your beneficiaries. So it is extremely important to name your beneficiaries. If you do not name your beneficiaries, the life insurance proceeds goes to your estate, and then there is a probate process, so it's a long road. So instead of that, always name your beneficiaries. You can have contingent beneficiaries, so you can have conditions. So if they meet conditions, they get paid in terms of life insurance. Example would be, I can have a contingent payment. So if my kid goes on to an university, then he or she gets $20,000 for education. If he or she doesn't go to university, he doesn't. Length of grace periods for late payments. So usually 28 to 31 days is the grace period given. After that, the policy stops. Reinstatement of a life policy means if the policy has not been turned in for cash, it may be reinstated. But it must again qualify as an acceptable risk. That is, your health should still be good. Non-forfeiture clause prevents the forfeiture of future benefits if you drop the policy. So if you drop the policy, insurance coverage stops. Incontestability clause stipulates that after the policy has been in effect for a period of time, the company cannot dispute its validity. So if you're paying premiums for a few years, then insurance companies cannot deny you claim, right, based on certain, let's say, small errors that you have made in the policy. If you're paying premiums and they have not identified the errors for a few years, then this clause helps you such that the insurance companies cannot deny you claims. Suicide costs usually first 2 years. So death benefit equals the amount of premium paid for 2 years. So for 2 years, you are only paid back the amount of premiums that you have paid, but not the entire death benefit. But after 2 years, then you are paid back the whole death benefit in case of suicide. Automatic premium loans usually uses cash value to pay premiums if you are not able to pay it. Misstatement of age provision will pay benefit premiums. So if you by mistake you have incorrect age that you have entered on the policy, this clause helps you to get claims. So even if you have misrepresented the age, insurance company cannot deny you claims, but it would adjust its claim based on the age. So let's say I'm 29 years old, I'm 30 years old, but in my policy by mistake I put 29, and in the event of my death, the insurance company will still pay me claim even if I have made a mistake, but they will adjust my proceeds according to my age. So instead of paying claims based on 29, they will pay claims based on age 30. Policy loan provisions allows you to borrow against cash value. A rider to a policy modifies its coverage by adding or excluding conditions or altering benefits. Example, waiver of premium disability benefit. So this rider are add-on things, so you can put it into insurance. So waiver of premium means if you get disabled, the insurance, you don't have to pay insurance premium. The policy still remains policy still remains active, but the premiums are covered by the insurance company now. So you don't have to pay premiums if you have this rider. Accidental death benefits, it is also called as double indemnity, means if you die, if the cause of death is because of accident, the policy pays you twice the amount it usually pays. Guaranteed insurability option, it means it cannot deny you from getting insurance. Even if your health deteriorates, the policy still remains in place and you can renew it. Terminal illness, so if you get some terminal illness, it pays some lump sum benefit and the policy still remains in place. Joint last to die, so you can have a joint life insurance policy between you and your partner, so whoever dies first gets, the other person gets the benefit. So whenever you are buying a life insurance policy, look at your present and future source of income, savings, group life insurance, group annuities, and government benefit. So look what you're already getting, right? Then determine from whom you want to buy your policy. Examine both private and public sources. Look for companies rating. Look for agents. So agents generally deal with one particular life insurance company, and brokers generally deal with many life insurance companies. So you can go to a broker to get different options. Agents generally will have a specific option of one company, but brokers can have multiple options, so it's a better idea to go for a broker. Compare policy cost, which are affected by companies' cost of doing business, return on their investments, mortality rate. Feature policy contains competition amongst company, so need to compare cost between different companies. Use interest adjusted index to compare policies. Takes into account the time value of money, because most of the insurance companies, there was a study that was done, so most of the insurance companies, most of the insurance policies are not even meeting inflation in terms of their return. So it is very important to use interest adjusted index so that you can compare if the policy pays more than inflation, right? Helps you make cost comparison amongst insurance companies that have different terms. Steps involved in obtaining and examining a policy includes submit application to a company, so you provide personal information, type of policy and limit of coverage, medical history, examine a policy, read it line by line, purchase read every word of the contract, get full explanation of terms and provisions, so in case of any riders and all, you need to get explained. After purchase, you can cancel the policy within 10 days without any penalty, and make copies for your lawyers and your beneficiaries. Now the most important thing, do not lie on your life insurance policies. Your claim can be denied in case they find any misrepresentation because of fraud and all those things. So if you want to be paid, so do not lie. So if you smoke, state that you smoke, right? Now settlement option, so you can take death benefits, or you means death benefits can be settled in different ways. So options are the choices on for how you want the money to be paid out. Most 70% plus is taken as lump sum, so most of us take means life insurance proceeds are taken as lump sum payments. Then you can have it in installments, so limited installments in equal installment for a specified number of years after your death. Life income option, payment to beneficiaries for life, for their life. Proceeds left with companies, pays interest to beneficiaries. So you have different, you can take lump sum, you can have installments for a limited term, you can have payments for the entire life of the beneficiaries. You can structure your closing options. Switching policies, it's generally not prudent to switch policies. So consumers lose millions because they don't hold cash life policies long enough, or they purchase the wrong policies. Switch if benefit exceeds cost of getting another physical and paying policy setup cost. So check while switching, are you still insurable? Can you get all provisions you want? And see, the important is insurance agents may convince you to switch, but in case of whole life, universal life, endowment policies, if you switch before 10 years, you generally lose out in terms of money. So stay on with your policy for at least 10 years. If it is a term policy, it hardly matters. But if you have cash enabled in it, then it matters. Now, next is medical insurance. Now, most of the medical needs that we have are covered by our provincial policies. So, the common term for that is Medicare. So, Medicare is a provincial health policy that covers most of the Canadians. So, most basic medical procedures are covered under the provincial government healthcare plans, but we still need supplemental coverage for semi private and private hospital rooms, private nursing care, cosmetic surgeries, physical testimony in court, prescription drugs, vision, and dental care. So, what happens is if you get admitted through your provincial policy, you generally have to share a room with three other persons. So, generally, it is a 3 by 3 room or a 4 room, means care facility that you generally enroll with. Now, if you want a private room or you want a semi private room where you have little bit of more privacy, then you have to pay from your own pocket. So, you can get supplemental health insurance to do that. Then two major things are not covered by our provincial policy. Three major things, I would say: prescription drugs are not covered, vision care is not covered, and dental care is not covered. So it's a prudent idea to get coverage for these three things. Healthcare cost outside Canada can be significantly high and may not be covered by provincial plans, so it is a good idea to get a supplemental life insurance. So, group health insurance, 65% of all health insurance is sold as group plans. So, generally provided through an employer. So, employer sponsored, employee may be part of the cost, covers you and your immediate family, and doesn't majorly require medicals, but you need to be with that employer to get covered. Then you can also buy individual health care that covers one person or the family, can be tailored to your particular needs. So, group health insurance generally provided by your employer. Individual healthcare you can buy. So, if you are a self-employed person, so you need to have an individual healthcare. Disability insurance so protects your most valuable assets, your ability to earn income, provides payment to replace income when an insured person is unable to work due to accidents or illness. So, disability is often defined as disability in own occupation, so inability to perform the duties of your normal occupation. So, full benefits are paid even if you return to work in another capacity. And regular occupation, the inability to perform the duties of your ordinary occupation, benefits reduced if you return to an alternative occupation. So, how it works, there are two policies: own occupation and regular occupation. Own occupation pays you no matter what. So if you return to your own occupation or you change your occupation because of your disability and do something else, then it pays you for no matter what. Regular occupation, the benefits are reduced if you get an alternative job. Disability is defined as any occupation. Full benefits are paid only if you cannot perform the duties of any occupation for which your experience or education qualifies you. Total disability so pays you when you're unable to work at all, and residual or partial disability benefits apply if you're able to work but at a reduced workload. So, disability insurance trade-offs that you need to consider. So there is a waiting or elimination period. So longer is the waiting period, lower are the premium. Duration of benefit, so you can get covered for 1 or 2 years, or you can get covered for 5, 10 years also. The premiums would be higher. Amount of benefits, so how much benefits are you being paid, accidental and sickness coverage, and guaranteed renewability. Source of disability income, so some part of it is already covered, so your employer covers it. Then you can have private policies that cover it. Then government also provides support, so it provides support in form of employment insurance and Canada pension plan benefits. So EI is a short term payment that is made for few weeks if you get disabled. CPP payments are generally made for a longer period if you get disabled. Then there is workers' compensation and short-term and long-term welfare payment that you can look at. So determining your disability income insurance. So what do you do? It's very simple. So you need to cover 70 to 80% of your after-tax income, right? That is what you should target. Now, second step is find out how much your employer is providing, how much government is providing. Rest of it you have to cover. So 80% of your income, it's let's say $50,000. Out of that, calculate how much EI will provide, how much CPP will provide, how much other government programs will provide, how much your employer is providing, and take insurance for the remaining. Consider waiting period and benefit periods. Critical illness insurance, this is important. Critical illness pays you when an illness is detected. It doesn't pay you in the event of death, it pays you before that. So that's very important, because sometimes if you get diagnosed with critical illness, it becomes very difficult and it's an expensive affair. So provides money for care if you are diagnosed with a serious illness or condition like cancer, heart disease, stroke, etc. Now it's a statistics that's quite scary. There is 1 by 4 chance that you may suffer any of the critical illness diseases. So the chances are quite high. So it's a good and prudent idea to get a critical illness insurance. Generally pays while you're alive. Tax-free lump sum payment within 30 days of being diagnosed. Most serious illnesses are not only treatable but curable, but the costs are very high. Can be used to pay off other debts or take time off work. Typical policy provisions include waiver of premium refunded to beneficiary upon death. Supplemental life insurance, after considering health and disability coverage available from government, employers and other policies, you may decide for further coverage, generally taken for dental and vision. So reimbursement of dental services and supplies, and preventive dental care like cleaning your teeth and all those things are also covered. Vision care insurance for your eyes. So health services insurance, so prescription drugs, semi-private, private hospital rooms, home care and nursing and other services of health professions that are not covered by government plans are covered. Travel insurance, hospital and medical expenses incurred outside Canada are covered. Accidental death and dismemberment insurance, so it's a form of a disability. Long-term care insurance provides day in day out care for long-term illness or disability. Long-term care means if you're getting old and you need help in terms of care workers and all those things, then this insurance covers for that. Americans buy it a lot, Canadians not so much, right? But with the aging population that we have, means personally I see an uptake in this kind of insurance, because then you're not dependent on anyone. You can cover for the care workers and the nursing workers that you need in your old age. Major provisions in an health insurance policy: eligibility, so it depends on age, marital status and dependency requirement. Assigned benefits, so what are the benefits that are assigned to you? There are sometimes internal limits. Internal limits means, for example, my policy has $750 internal limit for physio treatment. So if I exceed beyond that, I would not be covered. Co-payment clause, the amount the patient pays after deductible. Exclusions and limitations, so it has certain exclusions and certain limitations. Then you can coordinate benefits between different policies. So if you and your spouse has a policy that covers each other, then you can coordinate the claims, you can coordinate the benefits. Guaranteed renewable, no medical required generally. Cancellation and termination. Health insurance trade-off, so generally consider reimbursement versus indemnity. So reimbursement works, whatever you spend you're reimbursed for that. Indemnity pays a fixed amount no matter how much you spend. Internal limits versus aggregate limit. Internal limit specifies maximum benefit for a specific expense. Aggregate limit provides a total limit of coverage. Then you don't have internal limits for that. Deductible and co-insurance. Deductible means how much you pay, and co-insurance is in terms of percentage. So deductible is a dollar amount. So for $100 I pay, beyond that life insurance means health insurance company covers it. That is a form of deductible. Co-insurance means 10% I cover, 90% the health insurance company covers. So this is an example of co-insurance. Co-insurance expressed as percentage, deductibles expressed as dollar amount. Then there are out-of-pocket limits. Now this is important. Healthcare costs have significantly increased. So they were around $100 billion in 2000, and in 2010 it is around $200 billion. So it is expected that the current form of insurance government may not be able to continue. So it's a good idea to get a private insurance. So that covers this chapter. Thank you for listening. See you in next recording.